Okay, the Starbucks call just ended and the results are out. So we have updated our model to include the latest details for the March quarter and the changes in guidance that management gave tonight, although there really weren't too many changes. And we've updated it in our model, and we're going to take a look to see if that price move in after hours makes sense. So shares are kind of bouncing around the 5% to 4% decline mark right now, right around between $58 and $59 a share. So right now it's about $58 a share, down just over 4%. So we're going to kind of take a look at the results of our new updated model, and we're going to also compare it to the version that we had prior to today's release. So on the left-hand side of the screen, this is yesterday's model, and on the right-hand side is today's, which includes the March quarter. So you can tell because it's shaded in dark gray, and over here it was shaded in light gray. So this is saying that this was a forecast, and this is the actual results. You can also see that our model was calibrated to meet consensus revenue and EPS estimates prior to tonight's release. So let's scroll down and take a look at that guidance that management gave us. All right, let's see. It's after the segment results. Here it is, fiscal 2016 targets. So they start with the store counts, and for the store counts, they didn't really give much of a change at all. So we're going to start by looking at the total Americas segment. And I've already input the new store count guidance into these comments here. So prior to tonight's release, they guided full year to 700. No change there at 700. For the Europe segment, same thing. They had guided to 200 in last quarter, and then they guided to 200 again, new stores this quarter. And then for China, same thing. They had previously guided to 900 stores, and it's still set to 900. So it's not so much that there's a change here, but let's just kind of like take a look at the estimates prior to this release in total store counts and see where there might be a little bit of execution risk now, because the store count increases are a little bit more backloaded. So if we look at the Americas segment, we had modeled basically 176 new stores each quarter, and they only achieved 132 stores in the March quarter. So that means now in order to hit that 700 store count target, they're going to have to add 198 stores for each of the next two quarters, whereas they would have had to only add 176 and 177. So because these store counts are so far backloaded, that just adds a little bit of execution risk there. And then if we look at the operating margin guidance, let's go back to the press release. So for the Americas segment, they expect a moderate improvement year over year. So we put that in here, no change, moderate improvement. So last year they had 24.2% operating margin. We're modeling 25.1%. And let's take a look at where that stands relative to our model prior to this release. So we were at 24.8%. And if you take a look at the March quarter end, we had modeled 22.1%. It ended up being 23.5%. So that's really the reason for the slight increase. So there's about a 30 basis point increase in our margin for our model. And that's just to reflect the fact that March came in a bit stronger than what we had originally anticipated. Now if we go down to the Europe segment, the guidance for the operating margin, so we know the stores are the same. So prior to this release, we had estimated 40 new stores. They came in at 47, so this is a little bit different. They're 7 stores ahead of our original estimates. So we brought the estimates for the next 2 quarters down slightly. So less execution risk in Europe there. And then for the operating margin, we're down 20 basis points. Their guidance is calling for, they expect the margin to approach 15%. So before they had said they expect the margin to reach 15%. So, maybe it's going to be a little bit less than 15%. That language is always difficult to interpret. So we are now modeling 20 basis points below our original expectations prior to tonight's release. Next, we can move down to the Asia Pacific region. And let's take a look at the store counts. So we had originally anticipated 206 stores in March, and they fell well short of our expectations at 175. So again, the execution risk on adding new stores is a little bit higher since the new store counts are back and loaded. But the guidance stands at 900 for the year, so we set it to that guidance. And then if you look, they actually changed the operating margin guidance a little bit. So last quarter, they said that they expect the margin to be flat to down slightly year over year, and now they expect it to be roughly flat. So that's good news. We set it to 20.9%, which is exactly what we had in fiscal year 2015. So it's now meeting that new updated guidance there. Next, we can look at the channel development guidance. So for that, we don't have new stores, but they guided the operating margin to improve moderately. So we just had a slight improvement in total channel development operating margin in our model. And they also changed the tax rate guidance. Let me just check to make sure we got that here. Yeah, so previously it was a range of 34 to 35%, and now they've changed it to 34% for the full year. So you can see we have it spot on at 34%. And then the only other item besides the EPS is the CapEx, which they held constant at 1.4%. So if you scroll down to our cash flow statement, you can see we have it set to 1.4%. We didn't change the CapEx growth rates. Then we get to the EPS. So once we have all of those assumptions into our model, you can scroll up to the income statement because the segment details are what feed the income statement up above. And you can see that we've now come back to diluted EPS and for the next quarter and for the full year of estimates that are in line with their total guidance that they gave. So for the June quarter end, they guided to between a range of 47 and 48 cents, and we have 48 cents based on the estimates for operating margin and store count growth in the segment details below. And for the full year, we have EPS estimate of 188, which is the low end of the guidance of 188 to 189 per share. So now that we have the new results for March and the new guidance in for the full year 2016, we can take a look at this valuation. So you can see our model is getting back to about $59 per share. That is using the same multiple and the same DCF assumptions that we had prior to tonight's release. And just going to pull up yesterday's model. So prior to this release, we were at $61 a share. So yeah, a decline of 4% probably makes sense. We're not quite as low as the $58, but we're kind of splitting hairs at that point anyway. And we know that there's some variability in what the price earnings multiple should be anyway. So that probably makes up for the rest of the difference. And the fact that there's a little bit more execution risk on the new store counts for the back half of this year. So overall, the price move in after hours does look like it makes sense. So this updated model, including tonight's results, is available on our website, gutenbergresearch.com. You can click on the Models tab, scroll down to the Starbucks model, and click the icon to download it. And if you're interested in financial modeling, please be sure to subscribe to our YouTube channel, and also check back in a few days after the analysts have submitted their new models for Starbucks. We'll recalibrate ours to meet that new consensus estimate. Thanks for watching, and good luck with the rest of earnings season.